All right, so let's get started with today's session. Welcome, everyone. This is our session number 8 of Option Bootcamp season number 4. This is our 4th bootcamp. And in today's session, we're going to talk about options pricing and assignment risk, how to determine if my option is at risk of early assignment or not. So those are the two topics that we will cover. As always, everything that we're going to discuss, stocks, outlook, strategies, is all for education purposes only. Maybe a little bit of entertainment, but don't make the mistake of taking it as a professional advice. So just use it for your learning. From an overview perspective, we have done with the beginner level. We are almost close to the end of intermediate level of bootcamp. So the next session, the option trade exit checklist, will be our last in the intermediate level. Then we will jump into a little more details on how to manage trades, option Greeks, and then hedging, and some tips and tricks. That would conclude our bootcamp number 4. If you have missed previous session, and Steve, you may want to pay attention to this, is go to the website, optiongig.com, register as a user, go to members and bootcamp. And pretty much you can find all the sessions from this bootcamp. So recording is generally uploaded by the close of Thursday. So Friday morning would be the perfect time to go and check for the previous session recording. And if you find that is missing, it means I have done some mistake. So shoot me an email and I'll make sure we get the latest recording up over there. So today, let's talk about what are the factors that impact the pricing of the option. And then I'm going to look at how to determine if my option trade is at risk of early assignment, and then we'll open the floor for Q&A. So we're going to discuss what factors impact and also introduce option Greeks in today's session. So option Greeks, I'm not going to get into the details of option Greek today, but just give you an introduction of option Greeks. We have a separate sessions in which we're gonna get into, in depth into each of the option Greeks. So pricing. So when we talk about pricing, in case of a stock, there's only one pricing, which is a current market price, what you see. That's the price which is available. You can buy it at that price, you can sell it at that price or closer to that price. You got a bid and ask. Most of the time we try to buy or sell at the mid price, but that's the only factor that we need to be aware of to understand if my stock position is making money or not. So if I have bought a stock and stocks move in my favor, means if a stock goes higher, my trade is profitable. If I sold a stock, means I sold it short, and the stock goes down, it is moving in my favorable direction, the trade is profitable. When you're dealing with buying and selling of stocks, the price, the current price, is the only factor that will determine if your trade is profitable or not, or if your portfolio is profitable or not, depending upon what's the stock price of each one of your position. But when it comes to options, it's a little more involved. Stocks move in your favor, trade is profitable. Stock goes against your directional assumption, you got a losing trade on your hand. But if you're looking for option, especially when you're we are selling option, even if the stock price goes against your directional assumption, the trade can still be profitable. And I'm sure in this portfolio that we had constructed using 16 tickers, and then we randomly created our own directional outlook and put a trades on it, I'm sure some of those stocks would have gone against our directional outlook. So if I was bullish on it, probably some of the stocks have fallen down. But the trade still got closed because even though the stock went against our directional assumption, the option trade can still be profitable. And that's where there's a big difference between stocks and options. Specifically, when you're selling options. If you're buying option, then you're kind of tied up with the stock directional movement. If you're buying an option and you're bullish, generally you'll go and buy call. But then the stock has to move up. It has to move in your directional assumption for your call option to make money. But if you're selling an option, you can still make money even if the stock goes against your directional assumption. It is because the option pricing is impacted by factors more than just the stock price movement. So even if the stock has gone against you, it's okay because the other factors helped you. So let's get into what are those some of the other factors. Basic concepts. First, identify that this option pricing do not stay constant throughout the expiration cycle. By now we are in session number 8. By this time, this should be pretty clear because if you're trying to trade an option today, if you try to do the same option trade tomorrow or maybe an hour later, you may not be able to get the same pricing. It keeps on changing. Now, to know how the option price change and how it impacts your position, it is important to understand what are the factors that impact it. Now, this is how an option pricing is calculated. And it's all math behind it. It's got some put call parity. It's got a cumulative distribution function on the standard normal distribution. This is what most of the option trading softwares or market makers use to price the option. This is called Black-Scholes formula. This is not the only one. There are other ways to also price options. There are binomial function. But this is the most widely used, published in 1973, and the inventors were awarded Nobel Prize. But for us as a retail investor, we don't have to get into the details of this. I only look at this formula when I have to do a boot camp. For me, the option pricing is what I see in my trading software. Those who are market makers, or those who are trying to find out if any of the option is mispriced by a penny so that they can then do 1 million trades to take advantage of the penny mispricing, they might need to look into this. But us as a retail investors, we'll never have a need to even understand what is Black-Scholes formula for pricing option. So if we don't have to understand this, what do we need to focus on? So we need to focus on, first of all, how the options pricing is broken up. What are the different categories? At a higher level, the price of the option. So what do I mean by price of option is, for example, this one. If on Facebook, I'm trying to sell this option at $2.20. This is, for example, let's assume this is priced at $1.20. Now this $1.20, let me take a right example. Let's take an example of this one, 350. I'm trying to sell this 350 put option, which is currently priced at $20.45. Now this $20.45 has got two components in it. One is called intrinsic value. The other one is called extrinsic value. So intrinsic value is determined by the relationship between the stock price and the strike price. Now, in this case, stock is at 334. Say, example, let's assume it is at 335. So it is here. And my strike price is 350. So now the relationship between this stock price and the strike price will determine the intrinsic value of this option price. But the overall pricing, what we see right now is $20.45. Now, if I really look at the difference between 335 and 350, or to be exact, 333.68 and 350 is around $16.32. But the option is priced at $20.45. Where's the rest of the money coming from? That is what called as extrinsic value or time value. Now you'll hear these terms if you're trying to read through some literature or talking to someone, or even looking at some YouTube videos. Intrinsic and extrinsic premium, intrinsic value, extrinsic value, time value. Time value is what called extrinsic value. So every option pricing have these two components. It is possible that in some case, one of the component value is equal to 0. But this is how generally break down the option pricing into two bigger components. Now, what's intrinsic? And yeah, if you have any questions, please feel free to put it in the chat box. I am monitoring as we go along. So when we talk about intrinsic value, this is the inherent value or innate value of that option. And it is not dependent on any other factors, just where the stock is and where the strike price is. Only these two values. This is derived from the current price of underlying stock when compared with the strike price. Like I talked about in case of Facebook. Current price is $333.68, and I'm trying to sell a put here at strike price of 350. So the relationship between 333.68 and 350 will determine what's my intrinsic value. Everything else, the remaining portion of your option pricing is an extrinsic or time value. And that is derived from the factors which are other than the stock price, the underlying price. Now, this is where it starts to differentiate between options and the stock trading. When you're trading with the stock, we don't have to worry about anything else, but only the stock price. But when you're dealing with options, you have to worry about not just the stock price, because that will determine the intrinsic component, but also on the other components. So how to find out what's the intrinsic value? Now, in this case, how do I find out what's an intrinsic value? So an easy way to know the intrinsic value is when you are reach the end of the expiration cycle. Means no more time value left, because there's no more time left in the options. If this expires on 11th June, You're actually sitting at the end of 11 June. Just imagine that. That means no more time value left in the trade. So only value will be the intrinsic value. And if I were to exercise my option at that time, how much money will it make for me? Remember, emphasizing exercise. So we are looking at it from the perspective of option buyer, because only option buyer has a right to exercise. Option seller is assigned. So if I'm bought a put option and I want to know what's the intrinsic value of the put option, just I'll imagine that today is the last day. Now I want to exercise my put option right now and look at where the stock price is. If it is making some money, it has got intrinsic value. If it is not making any money for me, then it has got zero intrinsic value. Let's take an example. Stock, this is a call option example. Now stock is trading at 110 and you are holding a call option with a strike price of 100. And that call option is currently trading at $13.65. What's going to happen? Instead of doing a put option, let's pick something which is close to 100. Where is Unity? Okay, 98. Decent enough. And if I'm holding a call option, stock is 110, call at a strike price of 100. So strike price should be less than where the stock price is. So if I'm holding a call option for this, $90 call option, stock is at 98. I'm paying $10.70. So in this case, the intrinsic value will be the difference between your stock price and the call strike price. So your stock is at 110 and call strike price is 100. The difference between these two is your intrinsic value. Everything else is extrinsic. Now, in case of this, the stock is at close to 98. Strike price is 90. The difference between these two is $8, but I have to pay $10.70. So $8 is intrinsic and $2.70 is extrinsic. Now, let's go back and try to understand why. So if a stock is trading at 110 at expiration, and you're holding a call at a strike price of $100, how much money is this call option making for you? Obviously, it is $10. Because you can exercise your call at and get the shares at $100 and sell it at 110. So that call option is making $10 for you. That is why the intrinsic value is $10. Everything else remaining is your extrinsic value. Now, let me know if this concept is clear, or if it is not clear, I can explain again. But this is an important concept to understand: intrinsic and extrinsic. Now, let's take an example of a put option. Or let's another one on a call option before I jump to put option. Stock is trading at 55. And you have a call option for a strike price of 56, which today it is trading at $1.65. Now, what is the intrinsic value of this call option? Let me know, share your answer in the chat. Now, think through the scenario and assume that this is the end of expiration. Stock is trading at 55 and you are holding a call option which allows you to buy the stock at 56. Is there any benefit in holding that call option? Yes, no? As a call option buyer, is that option any beneficial for you? I would say no. Exactly. Why would I use this call option to buy the stock at 56 when I can buy the stock from the market at 55? So there is zero intrinsic value in this. So everything is extrinsic value. There is no red bar in this because it is not making any money for me, assuming there is no more time left. Let's take another example. Stock is trading at 58 and you're holding a call at a strike price of 59, which is trading at $1.25. What is the intrinsic value or intrinsic portion of this option premium, and how much is the extrinsic portion of this option premium? To let me know. Stock is at 58. You're holding a call option at a strike price of 59. It's the same case as the previous one. I will never exercise this call option to buy the stock at 59. When I can buy this directly from the market at 58. So this call option is not making any money for me. So there is zero intrinsic value in this call option. Everything in this is extrinsic premium. Another one. Stock is trading at 88. And you're holding a call for a strike price of 85. But that call is trading for $3.65. How much is the intrinsic value of this option contract? Okay, Ramesh says intrinsic is 3 and extrinsic is the remaining. Exactly. This call allows you to buy the option, buy the stock at 85, which is the stock is trading at 88. So it gives you benefit of $3. So that's why its intrinsic value is 3 and extrinsic is the remaining portion, 65 cents. So for call options, the intrinsic value, if a strike price is greater than the stock price, the intrinsic value is 0. Call options allow the buyer to buy the stock at the strike price. As an astute trader, I will never buy the stock at the strike price if it is higher than what the stock is available in the market for. So the intrinsic value is 0 in this case. If the strike price is less than the stock price, then the difference is the intrinsic value for that option. The remaining part is extrinsic value. Now let's look at a put option. Stock is trading at 70, put at a strike price of 72, but that is trading at $3.65. Now let's go back and to our session number 1. What does the put option allow you to do? if you have bought this put option. Again, from an understanding perspective, it is easy to understand if you think from an option buyer perspective. If you bought a put option at 72, what does it allow you to do? It allows you to sell the stock at 62 or at 72. Even though the stock is trading at 70, you will still be able to sell the stock at 72. That means you have a $2 advantage over the market. And that $2 advantage is the intrinsic portion of the option premium. The remaining is extrinsic. Let's look at another one. Stock is at 58. Now you're holding a put option with a strike price of 55, but that is trading at $1.65. Well, should be a response. What is the intrinsic value in this? If you are one of a trader who's holding a put option at a strike price of 55, is that put option beneficial for you right now or not? When the stock is trading at 58. Okay, I'll sip some water. Do let me know in the comments. So Abhay says yes. Okay, that's interesting. Put option allows you to do or to sell the stocks at 55. Why would you sell the stock at 55 when the stock is actually trading at 58 in the market? I won't exercise my put option. I will let the put option, I'll forget about the put option. I have a stock, I'll just go and sell the stock in the market at 58. So this is not beneficial for me. If you are holding a put option, then you want the stock to go below your put option strike price. If you're holding means you've bought a put option. So intrinsic value in this case is 0. It's only extrinsic value in this option. Let's look at this one. Stock is now trading at 72. You're holding a put option at a strike price. Stock is at 75. And you're holding a put option at a strike price of 72. It's the same story. If I've bought a put option at 72, I'm not going to use that. I'll directly sell the stocks at 75 in the market. So intrinsic value is 0. Everything is extrinsic value. How about this? This is a little different. Now stock is trading at 56. In this case, I'll be happy that I have a put option at a strike price of 60. So I don't care, even if stock goes to 40, I will still be able to sell the stock at 60. Now this is really beneficial for me. The put option is really working for me. Now using this put option, I can sell the stock at 60, whereas in the market, stock, those who don't have a put option, but they want to sell their stock, they'll have to sell it at 56. So I got $4 of distinct advantage because of this option. That $4 is intrinsic value. The other one remaining is extrinsic value. So when we talk about put options, if your strike price is greater than the stock price, it means put option allow you to sell the stock. at the strike price. So if a strike price is higher than where you could sell in the market, it is beneficial to have that put option. So intrinsic value will be the difference between the strike price and the stock price, not this one. So little typo here, it will be the difference between your strike price and stock price, because the strike price is higher. And if it is less than the stock price, intrinsic value is 0. This is the reverse of a call option. So overall, till now, we have learned that the option pricing have 2 major components: intrinsic value and extrinsic value, also known as time value. Because that is dependent upon what could happen between now and the date of expiration. So that's why it's called time value. Now the intrinsic value, as we have seen, is determined by the relationship between the spot or the stock price, the current stock price, one and the same thing, spot price or the current stock price. The time value is where things get a little more interesting. I wouldn't say complicated, because it is not complicated. If I can understand it, you can understand too. I'm not from a hedge fund background, or I'm not from financial services background. I spent all my life in technical field, running technology projects. So even a non-finance person can understand it. It's easy to understand, but it is interesting. It's not complex, but this is where things get interesting and start to differentiate between the stocks and the options. So that time value is not dependent on how much is the time to maturity. If we go back to an example, this. Today, if this is the condition, stock is 56, I am holding this put option, it is trading at 585. So tomorrow, at the same time, we are looking at this option. And thankfully, the stock is still at 56. But the option price, the same put option at $60, will not be trading at 585. It would have changed because the extrinsic value would have changed, because now we have gotten 1 day closer to expiration. So this extrinsic value will change based on how much time is available for expiration or for maturity of that option. What's the volatility? And this is it's a number that is derived. What's the volatility value of that option? What's the rate of interest? What's the risk-free rate of interest that is available in the market? Now, the reason why all these impact, because all these are the inputs that go into an option pricing formula. So if any of these things change, the overall option pricing will change. Now, on one particular day, stock moves up and down. We are slowly getting towards maturity. Volatility could change depending on, we got a different news from the company. And the overall impact of these changes is what determines the value that we see in our trading platform. So right now, if it is at 1070, 1060, if I try to do this 1 hour later, stock would have moved. Maybe Facebook, maybe Unity had some news coming out that would have changed the volatility and the pricing, which I'll try to get. It may not be 1070 anymore. The option pricing will change. Now, on day-to-day basis, some of the factors change, some of the factors don't change. For example, rate of interest, that doesn't change every day. That doesn't change. Even in some cases, that doesn't change for months. So I don't have to worry about rate of interest. Volatility, yeah, could change depending upon what day is it. If Unity is going to announce earnings today, the volatility will be very high because we don't know what can happen in that earnings. It could be great. It could be really bad. So there's a lot of uncertainty in it. So these are at a high level, these are the components that impact the pricing of options. Now you will be thinking, why am I even talking about it? So I'm going to tie these together to option Greeks, so that now we have a context behind option Greeks. And again, today is just a very basic introduction on option Greeks. We're not going to get into the details because you will only need to understand those details if you're really becoming serious on your option trading. If you're really using it as regular business for options trading. Now, the factors that impact the option pricing are collectively referred to as option Greeks. Let's go back. And I want to understand the strike price is constant, right? If I get into an option, the strike price of that option contract is constant as long as that option is valid. That doesn't change. But the spot price changes. It changes every minute. People are buying and selling stocks, so the stock price will change. So how to determine what's the impact on option pricing, overall option pricing, if a spot price change or if a time to maturity change? Every day we are getting 1 day closer to maturity, or if the volatility changes. So now the impact of changes in these factors can be quantified by option Greeks. That's where the Greeks come into picture. If I want to understand if the stock goes up by $10, everything else remains the same, what will be the option pricing? I want to know that. In that case, I need to understand Greeks. So now let's put the option pricing components and the Greeks together and see which one impacts what. All right, so maybe get your notebook out, pen or pencil, papers, or maybe on your laptop. Or you can come back and watch this video again. Delta tells us how the option pricing will change if the stock moves by $1. So if a stock moves by $5, you just multiply the delta by 5. If the delta of the option is 0.30, then if the underlying changes by $1, the option price will change by 30 cents. So the spot price or the stock price, the change in the spot or the stock price, its impact can be quantified by knowing the delta of the option that you're holding. If you're holding a call option and its delta is 20.20, if a stock moves up by $1, you shouldn't expect your option to move by more than 20 cents. If a stock moves up by $5, you shouldn't expect your option to move up by more than $1. We know upfront that the delta is 0.20, and if a stock moves by $1, my option pricing will change only by 20 cents. So this is one question that I see many retail investors like, hey, I bought a call option, out of a money call option. Stock moved up by $5. I didn't make too much money because you bought the call option whose delta may be 0.10. So if a stock moved up by $5, your option moved up only by 50 cents. So knowing delta will tell you how much your option pricing will change. Again, when we are looking at each of our Greeks, we have to assume that the other Greeks haven't changed. Right? In reality, all things change, but for us to understand the impact, we have to analyze it individually to understand it, the impact. And the net, what happens is the aggregation of all the changes. So delta tells you how it will change if the stock price changes. Calls have positive deltas, puts have negative deltas. Okay, you can look that in a trading platform. Maybe I'll bring up a trading platform and we will look at, let's do right away. So this is delta right over here. So left side is calls. Calls are positive deltas. Means if I bought a call option and if a stock goes higher, my call option will also go higher in value. If a stock goes lower, call option will go lower in value. Assuming everything, other components are unchanged. But if I bought a put option, if a stock goes higher, the value of put option decreases. That is why it moves in an opposite direction. That is why the delta is negative. Any question on delta? Again, we will get into the details of delta. This is just one application of delta from an option Greek perspective. In one of the later sessions, in fact, I have one session, I think, just dedicated for just delta, 1 hour only to talk about delta, because that tells us a lot more things about our portfolio. But I just want to understand any question on this very basic understanding of what a delta is. Right. Today, we are not going to touch the surface, because if you're not interested in getting deeper into options, why do I have to talk about how to use delta to determine risk in your portfolio? Right. All over here is maybe do a little premium harvesting, that's it. Now let's look at theta and understand what theta does. So theta tells us how your option value will change with 1 day change in days to expiration. And this is something which no one can control. You can artificially control the price of the stock by just holding the stock. But at least I don't know anyone who can stop the time clock. So time will always move forward. So this theta will continue to have impact day after day. Now, if you have to understand, today you bought an option, say of $2. Tomorrow, same time, nothing has changed. Stock is at the same price where it was when you bought that option. Volatility is at the same number when you had bought that option. But you will see that your option value has changed. That is because of impact of theta. So if you want to know how your option value will change, even if everything else comes to stand still, just because the clock is ticking, look at what the theta of your option is. If the theta of an option is 0.75, then the price of the option will decrease by 75 cents after 1 day. Considering other factors are not changing. So if you bought an option and nothing else changes, every day you are losing 75 cents. Of course, the theta value also will change. So let me make it clear. Every day you're losing the theta value. So if today theta is 75, means 0.75. So if nothing else change, this is like a hole in the pail of water. It drips. It decays the value of option. Both calls and puts have negative theta. Both will lose value. Doesn't matter whether you bought a call, whether you bought a put. If you bought it, you have to fight against theta every day, unless you figured out how to turn the time, how to go back in history. But if you have sold an option, this is your great friend. Because if I'm selling something and I've sold that option at $2, and if nothing else changes, tomorrow that option is worth $1.25. I can buy it back. So theta is a friend of option sellers, but it's a nemesis for option buyers. Okay. Again, not getting into the details of theta, we're going to talk about in a separate session. But let's look at theta. Oh, let me just pull up option Greeks, all of them together. So we look at theta, which is this column. All of them have negative values on the put side as well as on the call side. So if I bought this option, I know this will decay 6 cents every day, even if nothing else changes. That's what theta tells us. So today we talked about delta and theta. These are two very important Greeks to understand. Third one is for volatility. But these two are important. Any question on delta and theta? Okay, let's move on. Greeks, Vega. Now this is what differentiates between novice option traders and seasoned option traders, the impact of volatility. If you don't understand what volatility is, then my friend, we need to know it if you really want to become serious in option trading. Because this springs up surprises many times. I have seen cases wherein people have sold option, say sold put option. It means if the stock goes higher, that put option should be profitable, but it is not. Then you have to look into what's happening to its volatility. And its impact is most prominent on these all meme stocks, because the volatility is through the roof. We have seen scenarios in which, AMC have gone up $60. I'm like, too much too soon. Someone wants to take a bearish position, may buy a put option at say $50 or $40. Now AMC comes down from 60 to 40. In theory, that put option should be profitable. But no, because its volatility has also crashed. So it is important to understand what volatility is. Now, the impact of that volatility is determined by Vega. Again, as a retail option trader, I don't think you'll have to really look into what does that 1% move does to your option. But be aware that volatility plays a very, very, very important role in option trading. So if you have options in your portfolio, you gotta know volatility. But because we're talking about Greeks, so there's a Greek to understand the impact of volatility. That's called Vega. If a volatility changes by 1%, if the implied volatility changes by 1%, Vega will tell you how much your option will change, assuming everything else is the same. If Vega of options is 0.05, then the price of the option will change by 0.05 if volatility changes by 1%. Both have positive Vega. If volatility goes higher, the option premium goes higher. Right? We talked about trade entry criteria. And one of the entry criteria is look for higher volatility. The volatility where you want to sell an option should be higher than where the normal volatility is, because then you can get higher premium. That's the reason. Higher the volatility, higher is the premium. Assuming everything else is the same, that doesn't change. And that impact can be known by looking at value of Vega. Now, gamma is actually second order. So I won't spend much time. It could be confusing if you are seeing this for the first time. But remember, the delta tells us how much my option pricing will change if the stock moves by $1. Gamma tells us how the delta itself will change. So the analogy could be if delta is the speed, then the gamma is the acceleration. For now, I think for today's, this is enough in terms of from a gamma perspective. I'll talk about the use of gamma in, I think it's the next section. That's why I have to give a little hint of what a gamma is. So if the gamma is high, it means delta changes really, really fast. If a gamma is low, it means the delta doesn't change much. It means my option pricing won't change too much. The pace of the change, the rate of the change on option pricing will be less when the gamma is less. If gamma starts to increase, my options pricing starts to change at a very fast pace. That's all we need to understand from gamma perspective. Rho, this is the from a retail options traders, wherein I do option trades maybe 30, 60 days out, 75 days out. I don't have to worry too much about Rho, because this tells us how the option value will change with 1% change in interest rates, in risk-free interest rates. That doesn't change in 60 days. Fed has already told, not going to change the interest rates for next few quarters. We are all waiting for Fed to maybe change the rates, but they said we're going to keep it at near zero. So, but if you really want to get into the weeds and trying to understand, or if you're really doing an option trades, majority of the option trades are your leap options, which are like 2 years out, 3 years out, then understand how the Rho could change, because 2-3 years, the interest rate could change. And that, in that case, it might impact. For me, most of the trades are 30, 60, 65 days out. Interest rate do not change during this period. So that's why I don't pay too much attention to row. I don't think I've ever tried to figure out what's the row of this option. How will it change? I don't care. It doesn't generally have, it doesn't have much impact on my portfolio. So now we talked about Greeks. We also looked at what are the various components of option pricing. Let's put off all of them together. So these are the components of option pricing. Intrinsic value, extrinsic or time value. Intrinsic value determined by the relationship between the spot or a stock price and the option strike price. Time value is determined by the how much time is available for maturity, what's the implied volatility, what's your rate of interest. So let's flip this around and understand how this is how each one of them feed to create an option price. You'll get to know if you understand each one of these values, strike rate doesn't change. But if you have understanding of each of these values, sitting right now, you can figure out, how the option pricing will change in future. In practical life, you don't have to do it. Your trading platform should be able to do that for you in terms of try to predict those scenarios. But this is how they do it. These are the inputs that go into option pricing formula. So that's an overview of option pricing. These are always variable. They keep changing. If you bought or sold an option today, tomorrow it will be trading at a different price. Within an hour, it could be trading at a different price. Option pricing can be divided into intrinsic and extrinsic components. At expiration, extrinsic value is 0. Reason? This is a time value. There is no time left. So time can't impact anymore because it's expired. So the extrinsic is 0. And option Greeks will tell us how the option prices will change. Okay, I see one question. Paul says that does clarify. I wanted to do a limit buy order on Tesla, but sold puts after I joined this webinar. So far, I have not been assigned, but making 1K a week on average for the past five weeks. Risky, I know, but I'm okay because I wanted to buy at the price point anyways. Exactly. Well, that's the first section is when we're just transitioning from stock to options. If you are willing to buy at that price anyway, why not get paid while it hits your strike price? Why put a limit order? When you put a limit order, you don't get paid. But if you sell a put, it means you will have to buy the stock at that price, which you are anyway willing to buy. Why not get paid? So I'm glad, and thank you for Paul for using it, what you have learned as a coach. This is my moment. Okay, at least the webinar has been useful for someone who had not done an option trade. And you can still be only stock investor throughout your life, but just use options to buy it at get paid while you're waiting for the stock to hit your favorable price. If you want to buy, or if you want to sell it at a higher than market price, get paid while you're waiting for the stock to hit your selling price. So thank you, Bob. I'm glad it's working out for you. But yeah, if the stock falls down, you will be assigned at that price point, which in your case, you are okay to buy it anyway. So that's the more important thing. So now, how to find if my option trade is at risk of early assignment or not? So we talked about details of how the overall option assignment process works. Not exact science, little bit art. I may get assigned, and if you are following my trades, you may not get assigned, but I do send out an alert saying, okay, I've been assigned. I want to be transparent, and you may not have been assigned at that point of a time. But if I want to know, and this again, you would want to know it because in many cases, I might just sell a put or sell a call without ever wanting to own the shares in case of put. Right? When you start on option trade, I recommend you sell a put only if you want to own the stock. As you progress more and more, I sell puts all the time without any intent to acquire the stock. I'm just trying to do premium harvesting. In that case, it is important for me to keep an eye on, could I be assigned this tomorrow? If yes, then I need to make sure I have a cash available because I am, have a margin account. So how do I know if I could be assigned or not? Okay. So let's look at an assignment. Generally, you will be assigned if the option is in the money. Okay. There are 3 moneyness flavors: in the money, out of money, and at the money. So if your option, if you've sold an option, again, assignment applies only to option sellers. If option buyers, they're never assigned. They have the right to exercise. And when the option buyer exercises the option, it is assigned to an option seller. But you will be assigned if the option is in the money. If it is out of money, don't have to worry much. And the option is getting closer to expiration. Now, there are exceptions that exist, and that is why I'll cover it in this webinar. Those are the general surprises, because right now the June expiration is 18th June. It is around 10 days away. I wouldn't expect my options to get assigned to me, such early. But it could. Again, that depends on how deep in the money it is. And that depends on the criteria that I'm going to talk about in next 20 minutes. So if the option is ITM and the option is getting closer to expiration, but there are exceptions. Generally, most of the assignments will happen in the last week of expiration period. That is why I start to roll it out, because I don't want to take assignment. I had never had an intent of holding that stock, and the stock has fallen. It is in the money. Before it get assigned to me, I will take a corrective measure. Right? That's where it is important to know. Now, most of the time, it will happen in the last week. So for June expiration, assignment should start to kick in from next week onwards. But exceptions exist, and you could be assigned earlier. Right? Because there is no law that says option buyer has to wait. But this is one of many times we have this question in a pop quiz. If you are an option buyer, do you have to wait until the last day to exercise your option? The correct answer is no. If you're an option buyer, you bought an option today, you have all the right to exercise it whenever you want to. You want to exercise it tomorrow, go ahead. You may not, that's a different thing. But if you want to, go ahead. No one can stop you. So if I have sold an option, I could be assigned at any time. Because if buyer can exercise at any time, then the seller could be assigned at any time. But most of the time it will happen near just a week before expiration, in the last week of expiration. But sometimes it could happen earlier also. And let's look at the cases in which it could happen earlier. One is deep in the money options. The option has gone way deep in the money. Stock has gone really against my thesis, or not just against by a little bit, but by a lot. Then, if you look at those options, it will have a very low extrinsic value. And then there's a chance that I could be assigned. That is why I talk about this after we have talked about intrinsic and extrinsic value. So if it is a deep in the money with a low extrinsic value, that option may be at a risk of assignment. Or if you're sold a call and there is a dividend coming up. Now this is the most surprising element for everyone. You're trading options, you sold a call, you sold a covered call, and the only reason you're selling that covered call is to harvest some premium. You don't really want to give up your shares. You went ahead and sold far away covered call just to get some premium and reduce your cost basis. And then suddenly that company declares a dividend and you get assigned 20, 30 days before expiration. So many of the brokerage firms actually do a good job of sending a notification saying, this is going to be X dividend on this particular day, and you have a short call option on it. The reason they send this is to just let us, inform us that your stock could be taken away from you. So if you have shares, those could be taken away from you. If you don't have, you will end up into a short stock position. So do whatever you want to do. So these are two reasons. One is deep in the money options, whether call or puts. But even if a short call that you sold is not deep in the money, has got a decent extrinsic value, so that doesn't qualify for criteria number 1, but it's got a dividend coming up, and that dividend could trigger an early assignment risk. So let's take some examples. You got short in the money put option, means you sold a put. Now it's in the money. First of all, it has to be in the money. I've hardly seen any, which is out of money getting assigned. But this stock is at 50 or put strike is at 55. So this is in the money. The put price is currently $5.03. So based on what we learned today, the $5 is intrinsic value. Strike price is higher than the stock price. This is a put option. The difference is the $5 is the intrinsic value. Extrinsic value is 3 cents. So now, even if there are 20 days or 30 days remaining in this contract, I could be assigned this anytime. So be prepared. So if you have sold this put option at 55, make sure you have cash available to take an assignment at 55. Short in the money call option with a little extrinsic value. In this case, the extrinsic value is 2 cents. So is at a risk of early assignment. This is a short in the money call with an upcoming dividend. It may not be way in the money. In this case, the extrinsic value is not small. It's 82 cents. So, which is not little. I mean, $82 is a big amount for one contract. But if there is a dividend coming up and the amount of the dividend that the company generally pays is more than this extrinsic value, then this is at risk of assignment. And this happens only for short call. I trade in a lot of ETFs, those iShare ETFs. And they give dividend regularly. So I have to be aware of, okay, I sold these options. It's in the money. Should I be worried about assignment or not? I look at what's the extrinsic value. I look at what's the dividend is. If the dividend is lower than the extrinsic value, then I won't be assigned. Now, to understand it easily, just assume that when a buyer is exercising the option, they are giving away this extrinsic value. They have to forego this chance to earn this extrinsic value. So in previous cases, yeah, I may be okay to give away 3 cents. Option buyer may be okay to give away 2 cents. But if it's like bigger amount, may not be. In this case, if you're short call, means someone can buy the shares from you. They may be okay to give away 82 cents in extrinsic value, because if they get the shares from you, they're going to earn the dividend of 90 cents. So this overall, this transaction will become profitable if the dividend is coming up. So we already know what's the dividend, ex-dividend date is. So the buyer would like to capture the dividend and make sure to capture the dividend, the call option buyer have to make sure that they own the shares. They can own the shares by exercising their call option. So if you have sold a call option, you could be at a risk of assignment if the dividend is more than the extrinsic value, because the other party will be able to get 90 cents while foregoing 82 cents. So for them, it's easy math. So make sure if you are in such trade, look at what the dividend is, what an extrinsic value is, which will give an idea of could this be assigned early or not, and then you can take appropriate measures. You will not be surprised if you keep an eye on this. Let's take another example. Is that I have sold a call in which the extrinsic value is 82 cents, dividend declared is 56 cents only. In this case, I'm not at a risk of assignment, because even if the party on the other side is trying to get the shares from me, they have to forego 82 cents to capture a dividend of 56 cents. Means you're still losing close to 25 cents, which is a big amount. If this is close to, say, extrinsic value is about 56 or 57, then it is possible that you may be at a risk of assignment, because then the net loss is maybe a cent or 2 cents. So this is how you determine if your short option is at risk of assignment or not. Focus on extrinsic value. Now, how to find extrinsic value? Already shown. In Think or Swim, it shows extrinsic value right on your option chain itself. If it doesn't show the extrinsic value, say you sold a call option and it doesn't show the extrinsic value, you should look at the corresponding put option and see what the put option price currently is. These are all 16 cents between 11 and 20. This Okay, these are probably after hours. But this is one way to figure out. Go to the corresponding put option and see what's that put option selling for to determine if you could be at a risk of assignment or not. Best is just look at the extrinsic value directly. But if your platform is not showing it, if you're on a call site, look at the corresponding put site. So if the upcoming dividend is more than the value of that put option, then there is a high risk of assignment. No perfect science, but it does the job. We have to live with what the tools provide us. So if your tool doesn't show it, this is a roundabout way of figuring out why. There's a reason why it's equal to this put option. So what to do? Now you know that whether your option that is sold is at a risk of assignment or not. So if you have a naked call option, then you will end up into short stock position, which you may not want to. So take a corrective action before you get assigned. Maybe close your short call option by buying it back. If you have a covered call and you don't want to have the shares called away, maybe roll it out. Or if you're okay to have the shares called away, and then do nothing, let the shares be called away. Or if you have a short put, like this happens with me. If I have a short put, if I want to hold the shares, then I want to make sure that I have enough money or enough buying power available to hold the shares. If I don't, and I sold a put, means someone can put to me, in that case, I'll close the trade. Oops. So that's overall around how to determine if you are at a risk of early assignment or not. So increase the font for toss. My apology if it was too small. Let's close this. Go back here. So this is how you can look at and keep an eye on extrinsic value. Again, you may not need it if you're just starting off, but as you advance more, and this is where, we're already in an intermediate section, session number 8, one more session and we're done with the intermediate. So that's why we're starting to talk about these little more detailed and advanced topics about options. So if it is overwhelming right now, don't worry. As we move along, slowly, it'll start to make sense in terms of when to use this. And the recording will be there. Go back and watch it whenever you want to.